Welcome all. My name is Suresh. I'm the host for you, the people, to the moderator for the con call. This is a quarterly update on ASK convection portfolio. To give a ASK convection portfolio, we have Mr. Gagan with us. Very rich experience in equity markets, about 17 years. And before joining with ASK, he has worked with the different firms like Kotak and BNK Securities. At the same time, he has worked with the Paris-based AMC, which is called Comgest. So with this experience, today he is with us and he would like to give about 15 minutes of market outlook. At the same time, what happened in the last quarter and the way forward of the convection portfolio. I request all the participants, whatever the questions you have, request you to keep on the chat box and the Q&A session. So we will take the questions to Gagan to get the answers for you people. With this, I have handed over to the Mr. Gagan. Gagan, please take care.
Yeah, I hope I'm audible.
Yes.
Yeah, thank you. Good evening, everyone, and thanks for joining in. I'll take you through a brief presentation, and we can then jump into a question and answer session. I'll start by giving you a few highlights, selective highlights from the macroeconomic environment, which is pertinent for the equities market. You can see that domestic growth, specifically in the infrastructure segment, seems to have picked up momentum in the last couple of quarters. And that can be validated through the growth in the cement and steel consumption, which is almost entering into a double-digit sort of a YOY growth number. And the second order of validation comes from the railway and defense segment order inflow, which is really growing in a fairly strong way. It can be specifically seen in the order books of companies like Bharat Electronics and Bharat Dynamics. So Bharat Dynamics Limited's got an order book which is 10x its trailing 12-month sales. Bharat Electronics and Hindustan Aeronautics at 3.5 times trailing 12-month sales. Among the smaller companies, some have received strong orders for the train anti-collision device installation, specifically after the Balasore debacle. And then on the consumer staples part, the demand remains muted. That's possibly down to the high inflation we are seeing. And this is also possibly aggravated because of the very poor rainfall that we've had in August, which doesn't portend very well for the rural incomes or consumption going ahead. From the exports perspective, globally, there was a clear trend of inventory destocking, and this is largely being driven from the unlock in China. Demand in China was weak, and a lot of manufacturing companies which had built up inventories in anticipation of a strong demand coming back had to take price cuts and dump a lot of their inventory across the markets. This was specifically very strong in the agrochemicals and chemicals segment. And from whatever commentary we can hear in the chemicals and agrochemicals, this trend will continue for another couple of quarters before it stabilizes out. Also in the quarter, you could see companies benefiting from lower input costs, which showed up in margin expansion, specifically for the pharmaceutical and manufacturing segment. And we'll just to give you a flavor of how the destocking is impacted the exports growth. You can see merchandise exports have dropped right through the last quarter, and also on the services side, the IT revenues have also slowed down. IT, initially the slowdown was across a couple of segments, largely related to banking and retail, but in the last quarter, the slowdowns broad-based across other segments as well. So high tech, communication, manufacturing, utilities, all is more or less seen a slowdown in the IT business. Peculiarly, the TCV, which is the equivalent to the order intake for IT companies, is still healthy. What's seen a hit is the execution or the implementation of orders in hand, and renewal contracts have also been postponed. So that's as far as the IT services export is concerned. Just to give you a flavor of how things panned across 1Q FY24 for the equity markets, sales growth for the BSE 500 companies slowed down to a 5% number QOQ. And, as I indicated, the slowdown was more pronounced in the export-related sectors. So chemical, IT, metals is where you see a marked slowdown. Chemicals and metals is largely down to pricing coming down sharply, which in a big way can be attributed to what's happened in China. In IT, is across the board slowdown in IT investments in the last quarter. And margin expansion was broad-based across companies, and consequently, while the sales growth was not much, the operating profit growth was fairly healthy across the board. And if you again further drill down into sectors, banks, which had a very strong FY23, with net interest margins improving, credit growth being strong, and low provisions right across FY23. Now the trend seems to have turned on the net interest margins. With cost of funds increasing, the net interest margins are seeing some compression, and most companies seem to indicate that it will take another quarter or so before the NIMs stabilize. But they're quite hopeful that the rate hike cycle is more or less through, and therefore, come FY25, we'll see some improvement in net interest margins for the banks and BFSI segment. The consumption piece, as we discussed, is not seeing a strong top line growth. Margins obviously have improved because the logistics and input costs have softened a bit. So barring auto and premium segments, mass consumption is still seeing a slowdown. IT and chemicals was a very soft quarter for both of them. IT, we discussed somewhat at length. Chemicals, the volumes have not been impacted as much as the pricing has been impacted. A severe correction in pricing across most chemicals, especially the generic segment. While the innovative segment still sort of holds fort, and that's visible in PI industries. So, the exports for PI are largely for molecules which are still under patent, and they saw a robust growth, whereas most other chemical entities which are selling generic chemicals have seen a really strong price correction. And that's visible in a weak top line for most of them, which is flowed down into their margins as well. Pharma, you see a reverse trend. Pharma last year was a weak year. It was a perfect storm for pharma last year. Input costs were on the higher side, and output costs were dropping. And that is largely because there was excess inventory across channels, both in India and outside, post the third COVID wave. Stocking was extra normally high, and because of that, the primary sales sort of dipped throughout the whole of last year. This trend's now reversed. Inventory stocking is at normal levels across the pharmaceutical channels, and at the same time, input costs have also come down. So you see pharma companies reporting a good top line and margin expansion in the first quarter, and it's expected to continue. Pharma also had a weak FY23 because of the generic price erosion in US. which was fairly severe, a double-digit number between 10 to 15% across companies, depending upon their portfolios. And most companies in 1Q seem to indicate that they've seen some respite, and there have actually been shortages, and 6 or 7 critical large companies have gone belly up. 6 or 7 large critical suppliers have also faced either regulatory issues or issues due to adverse climatic conditions impacting, for example, Pfizer's injectable facility, because of the hurricanes there has been impacted, and that's the single largest injectable supplier facility in US, supplying almost 8 to 9% of the injectables. And that has also helped the cause. So you see shortages rising, and specifically so in injectables. And because of that, there's a reversal in pricing in the injectables. It's now actually moving up. Commodities, OMCs reported strong earnings with GRMs actually expanding, while metals and downstream companies reported weak margins. If you look at the investment bit, while cement saw a good top line growth, the margins are still not recovered. Energy costs were high, and cement companies haven't been able to pass it on fully in the quarter, and expect to do so in the coming quarters. Coming up to the conviction portfolio, just to give you a sectoral composition of the portfolio and how it stacks up against the index. Financials is the largest chunk, a quarter of the conviction portfolio, yet under indexed to the Nifty 50 TRI. Within the composition, slightly different banks, we are under indexed compared to Nifty. Infrastructure, we are over indexed compared to Nifty. Our holdings are largely in companies like APL, Apollo, and KEI, which supply steel tubes and wires and cables, which will go largely across infrastructure projects and construction activity. Chemicals, we are again over indexed versus the Nifty 50, and our exposure in agrochemicals is through PI, which I indicated. Three quarters of PI's sales come from contract manufacturing of agrochemicals under patent for a Japanese company called Kumei. They have not seen the same issues that other chemical companies have seen. They actually reported very robust top line growth as well as margin expansion in 1Q. Specialty chemicals, our exposure is through Navin Fluorine. Navin's got a long-term visibility of growth through 4 multi-year contract manufacturing arrangements, which will scale up from the second half of this year. While 1Q, they did have some weakness, and partially that's coming from a softness in prices of R22, R33, which are refrigerants which the company R22 supplies, and R33 they are in preparation for supplying from 2H onwards. They've also had to take a plant shutdown in their HFO facility, and they also had a breakdown in one of the facilities. So in summation, 1 quarter worth of sales lost in HFO, which impacted them in the first quarter. But the outlook remains strong because of the order book visibility. Technology, we've got exposure through Bharti and Reliance through Jio. Telecom is a consolidating segment, which is obviously leading to better business economics for the 2 incumbents, and we are optimistic about their prospects going ahead. We are slightly under indexed in the TNT, and I think that's coming from the IT portion. Consumption, we are broadly in line with the index, and healthcare, we've we are slightly on the higher side. Our exposure is limited to one entity, which is DVs, which is partially APIs and partially custom synthesis. And coming to the portfolio return from a 1 year perspective, how the sectors have contributed. So the top contributing sectors to the portfolio returns were infrastructure and engineering, which, as I indicated, is coming largely from APL Apollo KEI Industries, chemicals, which is Naveen and PI, TNT, which is Bharti and Reliance, and healthcare, which is DVs. The top detractors for the fund, largely Sona BLW, where we are not positioned anymore, and it's Dixon again, something which we are no more positioned in, and Patanjali and the Bajaj Twins are the other two detractors. This slide gives you a flavor of the 5-year CAGR in sales profits for some of our holding companies. You'll find that the PAT growth, compounded growth for 5 years for net profits is fairly healthy at 28% for these holdings, and the ROC is also at a very healthy 25% level. This again gives you the return compared to Nifty 50 across time horizons. So 1 year returns slightly below the index, 3, 5, 7 year returns exceed the index returns. While if you again further break down the 1 year return, the recent 6 months have been fairly healthy. In the past 6 months is where we took a hit. And on this slide, just to give you a flavor of our holdings performance in 1Q, sales growth of 21%, profit PAT growth of 21%. So a healthy number again compared to the index, where sales growth was 7% ex OMCs and profit growth was 19%. So this again gives you a flavor of the overall financial metrics and valuation metrics of the portfolio. The ROC numbers, as I indicated, fairly strong at 25%, EPS growth at 28%. If you look at valuations, yeah, they are on the higher side of the index, but that's also coming from the higher EPS growth and the higher ROC versus the index. And the index itself, as you see, is probably more than a standard deviation above its long-term mean. Market outlook, the concerns being monsoon and food inflation. Exports growth, as we discussed, took a hit in the last 6 months. Will be in a recovery mode coming ahead. Volume growth for the second half, sort of predicated on the festive season, which starts November. There is expectation that the consumption segment might see some improvement, but that is subject to the first two parameters of monsoon and food inflation sort of coming, the country coming to grips with those two aspects. And export growth will see some recovery, but it'll be a gradual process, both in merchandise and the services bit. Yeah, so that concludes my presentation. We can take questions from here on.
Thank you, Gagan, for in terms of the giving an update on the markets plus as well as the convection portfolio. The participants, I requested to have any questions if you have it. keep on putting in a chat box on the Q&A section. Gagan, few of the common questions which has come, just to think, giving this market conditions, I think you've seen that whether Nifty or Sensex about a 65,000, 66,000. So the question which is coming from one of the common customer is it a good time to look at in the portfolio to add money, or should is the right time to book the profit and keep it in a cash? So such a way has come in the one of the question. So I think it will be useful for the most of the customers because they all invest into the equity, and most of the having this question at their mind. So can you help him out, the customers, what to do now?
So two things. I mean, when you look at the market, I think you'll find that the stock performance splits right through the middle, with large cap not really seeing too much of a move. Mid caps and small caps is where the move has been very, very significant. The valuations are extraordinarily high. Personally, I think that is where one could, cash in. But if you have a high growth, high quality, high growth portfolio, and valuations relative to the indices are not expensive, we can continue holding out. And if one were to look at it from a 12-month perspective, some of the sectors will go through a recovery mode. Sectors like IT, pharma is already going through a recovery mode, and you'll see that the recovery will remain strong. IT will enter into a recovery mode in the next 6 months. In the valuations in IT, specifically large cap IT, are actually, to my understanding, very competitive at this point. So I'm giving you pockets where investments can, possibly from a risk reward perspective look good. Capital goods, everything seems to be in the price. While you see the order books moving favorably, I think it's more than priced in at these levels. Likewise, for defense, by and large, more than priced in. So, as I said, split across. There are pockets where investments can be made, pockets where investments should be held, and pockets where they should be liquidated.
Nice, Gagan. I think that's helped to the customer's point of view. A very interesting question has come from, I think, since we doesn't have any IT segment in our portfolio today, considering of the rise of the artificial intelligence, I think you're able to see that most of the places robots are using, most of the places artificial intelligence has been gone up by significantly high across the segment. At the same time, the IT sector, comparatively with other sectors, the stock market is under performance. So what is your view, and why you not holding any of our portfolios? Is the one of the question has come from our existing customer.
So while we don't hold IT, we are open to investing in IT. What we very closely watch are, the leading indicators which will show a turnaround in IT. What are the leading indicators? One, hiring. Hiring is virtually stagnated. It tells you something about what the companies are thinking in terms of growth prospects, because IT growth prospects and hiring move in tandem. Two, as I indicated, total contract value of new orders, TCV, is actually still very healthy for IT. It's the renewal contracts which are seeing trouble for IT. Once the renewal contracts come through and stabilize, which I think some companies are already indicating, have bottomed out. So on the cusp of recovery, as far as IT goes, IT again, you'll see a split. Mid-cap ITs had a good run. The valuations are actually above their long-term averages and converged to large-cap IT. It's the large-cap IT which has slowed down. As far as your question on artificial intelligence, most Indian companies in their commentary indicate that there is not yet a commercial use case. They are still sort of building proof of concepts and demonstrating proof of concept. So while it'll come through, it'll take its time. The immediate recovery in IT will probably come from traditional cost management and cost cutting programs, which is where everyone is focused right now in IT. Last year or the year before, the IT was driven from cloud investments or investments in digital platforms. Most companies who are customers to IT companies are now indicating that they've actually built up capacity and they want to take a pause and see the ROI on those investments before they go for a second leg. So you will see that in hyper converged companies or in companies which are building cloud infrastructure, there is a pause in terms of growth. And that has impacted the Indian IT companies as well. That will completely come into the base in a quarter or two, and then from there the growth will come from, as I said, the traditional cost cutting programs. And I think you'll see next year with a weak base plus TCV and stabilization in the base business, which is the renewal programs. IT will actually bounce back, and we'll try to time ourselves. We don't want to jump in very early, and we'll be selective in positioning ourselves, for companies which, as I said, the large cap IT segment is where valuations look much more attractive. Very very favorable compared to 10-year means, and 10-year mean growth for IT currency has been around 7% to be precise, 9% in rupee terms. And if you impute out the expectations in the price, it's the same today in IT. So priced per historical growth rate, very high dividend payouts, very high cash flows, so reasonably well positioned, large cap IT.
Thank you, Gagan, for the elaborative answer on the IT as well as the artificial intelligence segment. Now, if you look at in the staples versus the premium segment, I think you yourself in the which is question is coming, the demand is there in the premium products and premium brands. At the same time, in our portfolio, we are handling staples, where the staples are actually doing it in a declining growth of the declining growth. At the same time, as a Patanjali, which is into the business, are two ways. Why staples at the moment? Why Patanjali? So these two has come at the same time. So how I just wanted to club the questions I wanted to put you.
Right. So why Patanjali is a straightforward answer. Within staples, Patanjali, from a risk reward perspective, looks the best position to us. The kind of growth implied in the valuations is far more reasonable compared to a lot of other staple companies. And how do we see Patanjali sort of, in the future? The edible oil business where Patanjali's spreads, if you could say so, were the ones that were impacted. Even in 1Q, the spreads are impacted. The growth is fairly strong. You'll actually see volume growth's actually been 36% year-on-year in 1Q for Patanjali in their edible oils business. So a strong volume growth. It's the pricing which was impacted partially due to government also coming in to control prices. So as the food inflation tapers off, I think government intervention will also taper off. Long term, if you look at both Patanjali and its peer Adani Wilmar, you'll find that this business has a 2 to 4% sort of an operating margin, but it comes at very high asset turns to give you 18 to 20% sort of a return on investment. And we see this stabilizing. Secondly, we also, the interesting bit with Patanjali is that they are backward integrating into palm oil plantations. So today, their own plantations give them 10% of their own feedstock, which they use for refining, which will continuously grow from here as their plantations start yielding fruit. On an average, once you plant it, it takes 4 years before it matures and start yielding fruit. So based on the cohort of plantations which reach maturity, increasingly they will rely on their own plantations to give them the fresh fruit bunches, which they'll use for refining edible oil, and that will also sort of give them some immunization. Their plan, actually, a 10-year plan, is to backward integrate almost to 70% through their own palm plantations. So strategic thinking is to immunize this business from a variation in spreads. Their growth and their profitability is largely going to come from their food and nutritional business. While food and nutrition, if you are at market parity in terms of your market share or your penetration in categories that you want to play, you would be in mature growth phase, but not so for Patanjali. They are actually entering into certain categories. So nutraceuticals is a category that they have entered into. Dry fruit, branded dry fruit is a segment that they've entered into. So these are segments where growth can be more of an inflection or a hockey stick growth, because the company is trying to basically build up their business in this segment. So for Patanjali, the growth will be on the higher side of the other consumer companies, and this is their most profitable business, and this is the one which will grow the fastest. Their aspiration is pretty strong in these businesses. So biscuits is a 1,200 crore business. They want to take it up to 1,500 crore in a 2 to 3 year time frame. Dry fruit, as I indicated, 1,000 crore aspiration in 5 years. Nutraceuticals, which is today at an annualized rate of 250 crores, they want to build a 2,000 crore sort of a business in the coming years. They've laid the ground, they've built the management team, they've built the capacity, and from here on, it's about planting the products in their distribution and growing their distribution. So I think a risk reward in terms of the growth available versus the valuation available, Patanjali seems to be the best positioned in staples for us.
Great, again, for the insights of the Patanjali, which has put again clarity to our clients. Again, put into the ASK convection portfolio, which the last 6 months has done a great job. So have you done any changes in the portfolio to deliver the returns in the last 6 months? And the way forward, how if the clients is the one question is coming, if I would like to stay for the next 2 to 3 years, what type of returns I can expect from the ASK convection portfolio?
So, the changes that we made were largely rebalancing. So, we reduced our position in APL Apollo, nothing to do with the company's performance, which has actually been very healthy, and their growth targets are also very healthy. It's just that from a risk perspective, the position size had reached a very large level, and we thought, we need to rebalance it. The other rebalancing that we did was in PI Industries, and the reason again is risk focus rather than growth. Returns and growth have been very strong for that company. Our concern is that one product which they supply to their Japanese partner QMI, which is pyroxasulfone, is now almost 55% of their sales. In exports itself is 75% of their sales. So this one product dependence is pretty large. This product is actually doing very well for QMI. We go through QMI's calls and transcripts to understand, how this product is moving. Even in the phase last three months where agrochemicals have seen a discernible slowdown. Companies have seen 15, 20. If you look at the global companies, FMC, New Farm, they all reported 15, 20% drop. PI has reported strong growth, so has QMI. Our concern arises because in 26 and 27, patents around these products start going, off. While there's no one patent which protects the product, it's a combination of patents which will expire over a period of time and will expire at different points in time across different geographies. And at the same time, from what I'm able to understand, PI is also on the verge of scaling up 2 more products for QMI, which may well scale up to the same size as pyroxasulfone today, which may not, because we don't really understand these are not products on which the company talks about in great detail. So basically, building up around those concerns, we've sort of reduced our position. Yeah. So these are the two rebalancing, and largely, as I indicated, keeping risk in mind rather than returns. As far as the portfolio growth is concerned, I gave you a flavor in the presentation of what we think can be earnings growth for our holding companies in the coming 2-3 years. And as far as valuations go, we know that market valuations today are slightly on the higher side. And if there is a normalization there, I think our portfolio will also see some amount of normalization. So growth could vary around our earnings growth for our portfolio to the extent that the multiples might normalize. As I indicated, multiples today, broad-based multiples today across for the sector, or for the industry, for the market as a whole, are one standard deviation above mean, probably slightly more than one standard deviation above mean. Does it correct back to long-term means? I don't think so. 2 or 3 reasons. One, there's clearly a rotation out of the traditional favorite emerging market, which was China. 30% of Chinese GDP comes from exports. Everybody in the supply chain in US and Europe is looking for possible alternatives to China. Export growth, therefore, for China is going to be weak. It's not going to be a one-off feature. While it got aggravated because of COVID-related lockdowns, you clearly hear both Indian and MNC companies talking about China +1, even Europe +1, given the energy costs that Europe faces today. So there is clearly a rotation in manufacturing and pharmaceuticals and chemicals away from China and away from Europe into other territories, and India will benefit. So to that extent, there is a secular move towards India. That is one. Second, China's real estate is impacted in a massive way. Their largest real estate company, Evergrande, is filed for bankruptcy. That's 55% of Chinese GDP, which is impacted and not impacted, on a temporary basis, but on a long-term basis. So the rotation away from China is here to stay. So to that extent, multiples in India, which from a GDP growth perspective is probably on the opposite end of the spectrum versus China, very well positioned in terms of the government's FX and fiscal deficit standpoint, and prime pumped for investments on the public sector side. Now following up with capex in the private sector side also. So I mean, clearly on the fundamentals, India is on the opposite end of the spectrum, and justifiably, therefore, valuations will remain on the higher side. There will be pauses where market will, take a respite because valuations tend to run ahead of fundamentals every now and then. And as I indicated, chemicals was impacted because of the transitory pricing phenomenon coming from destocking. So, there might be some corrections in valuation, but it won't be a deep correction as far as I can understand. So, the proxy for portfolio growth is some correction in valuation plus the earnings growth of the portfolio.
Well, I think the sounds everything. Coming to the question which is coming is on the BFSI segment, the banks and finance service segment.
Yeah.
If you look at in our portfolio, we have a high quality, high growth the portfolio of Bajaj Finance and Bajaj Finance. But one of the customers is asking about, there are some segment like a Aditya Birla Finance, IFL Finance, ICICI Securities. This segment of the Dan has done good job than the companies in the last 1 year and 2 years perspective. Are you regret that? Do we not participate in that? Are you looking into those ideas for the future? Is the one question has come.
Okay. So, as far as this segment is concerned, our holdings have shown very good growth. If you look at Bajaj Finance, AUM growth of 30%, right? AU loan book growth of 27-28%. The NIM compression is not unique to these companies. The net interest margin compression has been across the board for everyone. The degree varies depending upon, to what extent is your book fixed rate and variable rate. Cost of funds has gone up for everyone, right? More so for BFSI than for banks. What has happened in the last year is probably the PSU banks have been a very strong play because they were positioned as deep value. They've gone through that phase of restructuring, and the same tailwinds which you see in our holdings, you've seen for PSUs, just that the valuations there were what they were, and therefore that is a trade which you saw very strongly in FY23, and also the companies that you mentioned. Here on, how does it work? Do our companies slow down in their growth? No. I think if you look at the commentary that Bajaj Twins are offering and the growth that they're demonstrating, they'll remain in that corridor of 25% plus growth. They're actually incubating, Bajaj Finance actually incubating newer businesses which will give fillip to the growth. I think it's only one pocket, which is personal loans on the rural side, which is where they raised not even a red flag, a yellow flag in terms of concerns, and which might see a slowdown. So, we are a concentrated portfolio. So I have to think not just in terms of return, I have to think in terms of risk, because we are not optimally diversified, and that's deliberate. To a certain degree. So we want to ensure that we have quality in our holdings. If there are holdings which offer risk reward, without compromising on quality, we are happy to take them. And this is an ongoing discussion we keep on having internally. As of today, we maintain our position in these companies. AU has talked of improving cost to income ratios, maintaining growth, and therefore you'll see a company which will keep on growing and over a midterm horizon actually improving cost to income, improving profitability, and they've demonstrated very strong growth. But so has Bajaj. So as of today, we maintain these holdings. We'll keep our eyes open, and if there are companies which offer better risk reward, we'll put it out.
Excellent. So coming to the last question, what we are having at the moment is about the pharma sector, where in terms of at the moment, we've been holding for the DV so long. Yes. At the same time, pharma is been going to the trouble for as you mentioned about the price erosion, the same time price compressions which happen. So can you just elaborate in terms of for our view for the participants, what is you are looking at the pharma sector in a very just way? At the same time, Divis has been holding for so long in terms of the conviction in the portfolio. At the same time, have a so conviction. So what's the
prognosis there?
View for the long term point?
Okay, so specifically on Divis, let me put it this way. If you look at the API basket, Divis is an API company. 50% of their API sales is, toll manufacturing of APIs for large MNC companies. These are products which are off patent. And Divis' strength lies in being able to supply it at the most cost-effective level. 50% of the portfolio, roughly, again, comes from what is called custom synthesis, which is essentially supplying, products both on and off patent, but not as a toll manufacturer with price linked to the market pricing. So these contracts are long-term contracts with, planned pricing, let me put it that way, and therefore they offer very high margins. And that is the portfolio construct of Divis. What happened to API companies in last year, and you can validate that by seeing the result of companies like Glenmark Life Sciences, Aarti Drugs, IOL Chemicals, Laurus Labs, Granules. These are all API companies in India. You will find in FY23 their margins contracted severely, not just by a small amount, a very severe correction. Why did that happen? Combination of reasons. Input prices jacked up really severely. Solvent prices were up 4 or 5x. At some point, probably more than that. Solvents are big inputs for these companies. Energy costs, huge. These are all companies based out of AP, Telangana. And there's been a power tariff increase and a severe power tariff increase for these companies. Even Laurus talked about it. So did Granules. So all of them saw input price increases last year. And as I said, their output prices were actually lower. Why did that happen? That happened because there was, as I said, excess inventory in the channel, because of which formulation companies were unable to sell to their channel partners. If the formulation companies are not going to be able to sell their own produce to the channel, they'll pick up less from the API companies, which will mean that there is excess supply versus demand in the API industry, and people will, supply at lower prices just to cover fixed costs, which is how it transpired the whole of last year. In DV's case, the problem gets exacerbated because of one more reason, which is that they were very sizable and single supplier to Merck for Merck's COVID drug molnupiravir, and that supply trailed off post-COVID. So a double whammy for DVs in the last few quarters. One, as I said, high input prices, low output prices, high energy costs, high freight costs. Freight costs were up 5-6x, and refrigerated freight costs were higher than that. All of that impacted DVs. Now, in a quarter's time, all of this will have vanished away from the base. Up to second quarter of last year, they were supplying molnupiravir. Second half onwards, that discontinued. So one more quarter where optically DV's top line will look weak, right? And that is because that one product for COVID was still there in 2Q of last year. Thereafter, that base cleanses out. Secondly, the entire input-output equation is reversed. Input prices have actually dropped down now. Freight prices have dropped down and dropped down drastically, and output prices are now moving up. So, what you see today in DV's margins, which has come down from their long-term average of 35-37% to below 30, is now on the move up. So in a quarter's time, DVs will start reporting a healthy top line and margin sort of profile. Add to that, 3 or 4 very interesting contracts. So DVs has supplied validation batches for contrast media. Contrast media, let me give you some idea, are used for CT scans, CAT scans, and for MRIs, right? If you look at this market, this is a $7 billion formulation market globally, controlled by 4 companies globally. GE and Bayer are the 2 biggest companies. GE alone is 45% market share globally, right? And contrast media, they have so far largely depended upon themselves and 2 Chinese suppliers. DV's is now the only, 3rd or 4th approved supplier for these large companies. And DVs will start scaling up their supplies. To give you a perspective, 20% of the formulation market is API in this space. And as I said, only 3 companies today. Apart from the innovator, actually only 2 companies supplying. There's a severe shortage. If you look at US FDA indicates iodine-based contrast media used in CT scans are today in severe shortage in US. So is the case in Europe. And therefore, DVs will have a strong run. Not only, will DVs partner the innovators, which is Bayer and GE and Bracco in supplying these products, DVs clearly indicates that their iodine recovery is the best in the business, which basically means that they are the most cost-effective supplier. So what you see DVs do with naproxen a few years ago, build out a market share from scratch to virtually market leader with almost 40-50% market share, at some point even 70% market share, even as prices of naproxen dropped from $100 to $30 a ton, is what you'll see them replicating today again in contrast media. They've already gotten approval for 5 iodine-based products, and they'll now get approval for 2 gadolinium-based products, which will go into MRI. MRI again is a further more concentrated market. So I think you'll see a phase where DVs will see a jump in their contrast media sales, sizable jump, and this will come with very good margins. So there will be a reversal, and I'm not saying that based on hope. As I indicated, there is a lot of evidence to what they put in place and what they're going to commercialize in the coming 2-3 years. So that makes DVs an interesting case to keep holding on to. In any case, we know DVs has a very strong demonstrated past track record. And you will see that reversal playing out. More than a reversal, you'll see some very interesting products playing out for DVs. On pharma, this is a space where everybody's the index itself is what 3.5% positioning in pharma, and most fund managers would have had under-indexed themselves to pharma and positioned themselves in domestic pharma. Largely because we've seen what's happened with US pharma, US generic pharma business. Now that business is again, seeing a reversal. Is that a secular reversal? Unlikely. What happened to generic pharma? 10 years ago, generic pharma was giving you an ROC of 25% or more. FDA used to come into India to inspect a facility after giving you 2 months of notice, so that you could patch up everything and show them a clean slate. Number of suppliers versus number of buyers was a favorable equation. Last 5 years, everything changed. The distribution channel in US consolidated to a point where today 3 distributors control 85% of the US market. They started dictating terms, both in terms of pricing and working capital. That impacted Indian companies. US FDA started coming without giving any notice and increased the frequency of their inspections. And the Indian companies went through a learning phase and a very steep learning curve. Obviously, your ROIC goes through a cyclic downturn, and to the point where a couple of years ago they reached a point where probably most Indian companies were generating losses. If you adjust for the R&D that they do for US, their entire R&D is actually for US. And what has happened in the last 6 months, I gave you some flavor, which is that because the business economics became so unfavorable, large companies like Teva and Mylan actually forfeited a lot of their ANDAs because there was no commercial value to them. Their balance sheets were stretched to the hilt. They were leveraged to the hilt, and they couldn't invest any more in R&D. And therefore, they actually vacated oral solid dosage market in the US generic business, which led to the phenomenon of shortages happening. Injectables, in any case, is a space where the burden of regulatory compliance is so high that it's a market which is perennially in shortage. There's a percentage of variation that sort of keeps moving up and down. One very large supplier is India-based company called Intas. Intas is probably the largest supplier for carboplatin and cisplatin, which is oncology drugs in US. Their facility went into regulatory turmoil and severe shortages in oncology drugs in US. So this is now a phenomenon which sort of snowballed into a case where 8 large suppliers based out of US vacated, forfeited ANDAs, 6 large injectable suppliers facing regulatory action or bankruptcy. If you look at it, Mr. Raju Penmetsa, who was the original promoter of Gland, is actually gone and acquired a company called Sept in US, which is a very large injectable supplier. Mr. Penmetsa doing it now clearly tells you that he sees, a really good opportunity. Otherwise, to have to come back in this market at this point in time through his own private equity wouldn't make sense. So clearly, there are favorable trends validated by some very strong and reputed entrepreneurs' actions also. So you'll see an improvement in the business economics of US-based generic companies. The India piece remains sturdy double-digit sort of early double-digit sort of a growth profile for most of these companies, and we are actually very actively looking at them. We've actually shortlisted a couple of them, which we think are good for our portfolio, and we should be in a position to add onto our pharma exposure through these business models in the times to come.
Excellent, in detail of the explanation of pharma sector and DVS. Considering of the last 3 minutes, I'll just would like to have one last question has come, which you can pose that we can wind up the session. I think you have seen that across the globe of the destocking happening on the across chain and everything also. So what is your impact on the portfolio, which is on the any of the chemical stocks we are holding on? That is the question which is coming. So that is the last question.
Yeah, so the piece, the chemicals exposure, as I indicated, is through PI and Naveen. Naveen, I already indicated, has 4 multi-year, long-term supply arrangements with global companies. Large companies like Honeywell, Bayer, Fermion. So up to this point in time in the past, they were supplying only to agrochemicals. Now Fermion is actually a large API manufacturer for Bayer, and Fermion is giving them contracts for pharmaceuticals also. So you'll see their pharmaceutical exposure rising. Their capex is in the pharmaceutical space, which is basically, FDA compliant grade 3, grade 4 facilities will also come through in the coming 6 months. So we are positioned ourselves for that exposure. If in the next coming 2 quarters, market further punishes these companies for a transient bad patch because of destocking, we'll be happy to load ourselves up, both on Naveen and probably also some other companies which we keep monitoring very closely. And we keep reading commentary from the MNCs, from agrochemical and pharmaceutical MNCs, to understand what they think about supply chain diversification. I think you'll find that it's very well validated in their strategic intent also, that they want actively to scale up their supply chains from India and other markets. You'll actually see Italy recovering back in the API supply. Italy used to be a very strong API supplier to US 10 years back, and in the last 10 years they lost out to China, and now you'll see Italian API companies have actually shown very good numbers. So clearly validates, and you'll see newcomers like Ami Organics or Aether Industries, multi-year supply contracts to European drug manufacturers. So this story has legs. Let me put it that way.
Thank you, Gagan. That's where we end the session today. Thanks all the participants who have joined here. Participants, and we will be sharing the recording link to your in terms of the email IDs, and we will meet the next quarter update from the Gagan side. Thank you.
Thank you for your time.